Hello, everyone, and welcome back to this episode of the Rosa and Rubini podcast, Making Sense of This World. There's been a lot of turbulence in geopolitics, as we've discussed over the last couple of weeks, but even more so perhaps in the financial markets recently. And today we wanted to break that down for our audience. Brunello, all the sort of volatility in financial markets that you wrote about in this week's newsletter, can we just get a bird's eye view and some stats to contextualize how important this is?
Sure, there has been lots of turbulence in financial markets in the last few weeks, and in particular, last week was pretty bad. The major global indices lost 2-3%, and with last week very negative performance, the S&P 500 recorded its second worst start of the year in a number of years. Minus 17.5% in the first 91 trading days. So pretty appalling performance, especially the tech sector has severely underperformed. And within it, there have been stocks that have lost 50, 60, even 70% of their value, including some of the major stocks that people follow, such as Netflix and similar ones. So as a result, VIX, which is a measure of volatility, has spiked way above the year average and even above the last 10 years average. So it was really a pretty bad week for financial market last week.
Yeah, no, that does sound quite concerning. And I mean, there seem to be quite a sort of multitude of reasons for this, many of which are connected to the turbulence in the geopolitical space. You outlined 5 of these in your newsletter. Can we go over them briefly?
Sure. Investors have been particularly worried about the fact that central banks might not be able to engineer a soft landing the way they said they could, or they thought they could, after increasing rates so much to control inflation, and therefore somehow recession fears have increased recently. What are the major concerns of investors? As I said, we quoted multiple reasons in our newsletter. First of all, clearly the continued tensions in Ukraine with the war between Russia and Ukraine that doesn't seem to go anywhere in terms of finding some form of resolution anytime soon, with the Europeans that prefer a ceasefire almost at any cost, under any conditions with the Russians, and the Americans that clearly prefer the war to continue. There have been clearly an idea that with accelerating inflation, also monetary policy tightening will need to accelerate in coming months as well. Last central bank that has effectively given up on the idea that they can wait for longer was the ECB. Then we have already the lockdown in China going on for quite some time that has further disrupted global supply chains, including tensions in the energy markets continue, and they don't seem to abate, and will probably continue to have an impact both on growth and inflation in coming months into next year.
Right, so a large multitude of reasons. And I think one of the interesting phenomena that we've seen is this flip in the correlation between bond and stock prices. Now it's negative, it was recently positive. Could you tell us more about the implications of that and why that happened in the first place?
Yeah, I think that's one of the most interesting phenomena of last week. Traditionally, bonds and equities are negatively correlated, and almost by design, I would say, in the sense that investor can always invest in equities when things are looking good. They can always invest in bond when things are looking a little bit less good, and therefore there's always somehow an escape asset class where to go. But then recently, that kind of negative correlation broke down, given the stagflationary scenario in which you have reducing growth and increasing inflation, which means that this is negative both for bonds and equities. We've discussed this many times. And this means that we had a sort of positive correlation between these two asset classes in the last few months. But last week, we returned to old-fashioned negative correlation. Equity prices collapsed, but bond yields also went down. And these happen at the same time. Other two phenomena happen. One is that credit spreads have widened with an increasing in high yield bond yields. So junk bond yields actually spiked to the highest level since 2020. And the other phenomenon is that bank equities are also suffering. How do we interpret all this? Well, if you have stagflation fears, you had this sort of positive correlation between stocks and equities. But if recession fears become larger, then the negative returns that you expect to have on the economy will weigh on banks, therefore bank equities are going down, will weigh on credit, therefore credit spreads increasing as yields increase, while long-term bond yields go down because the market expects a little bit less tightening than before, exactly because there might be a recession down the road. So this is our kind of interpretation of last week movement.
Sure, sure. I mean, and the last thing I wanted to ask is obviously we know financial markets don't operate in a vacuum, and increasingly so they're impacted by the sort of alternative space of crypto markets. And you pointed out in your recent views letter that the big sell-off in the cryptocurrency space has really exacerbated the volatility in traditional financial markets. Can you tell me a bit more about that?
Yeah, I mean, last week was pretty terrible for the crypto asset sphere as well. Lots of important headline so-called cryptocurrencies suffered, clearly the Bitcoin, but also much more staggeringly the so-called Luna coin that was associated with a stable coin called Terra USD, which was supposed to be stable till it was proven that it wasn't that stable. In fact, its value collapsed almost to zero, also because instead of being backed by solid collateral such as bonds or real assets of some sort, it was backed by the so-called algorithmic trading, which means that it relied on the fact that the market would take care of the peg. Clearly, the market didn't take care of the peg, and therefore the Terra Luna trade collapsed. Now, and also among others, Tether, the most important stablecoin out there, for a period lost its parity to the dollar. It wasn't 1-to-1 anymore. It traded to 95 cents on the dollar. Now, these may be significant because there are apparently something like 80 billions in collateral for Tether, and we are talking about effectively the size of a large hedge fund. Now, if a large hedge fund goes under, we know there are ripple effects in the economy. So we need to start thinking what happens to other markets if one of these big crypto assets collapses. If there were to be, for example, a fire sale in the collateral just to keep the peg going, that could have repercussions in traditional financial markets. Now, the mechanism for that to be systemic to some extent, we are talking about a relatively small asset class, 1.3 trillion US dollars is minuscule compared to other asset classes. But if there were to be leverage on these assets, then the ripple effects could be much larger. Luckily, regulation or technical impossibility makes leverage on these crypto assets quite complicated, so it's not there, and therefore problems in that space tend to remain isolated to that space. But that might not be the case in the future, and so this is kind of a call for regulators to start looking seriously that space and not disregard as a small thing for geeks is actually something that is becoming pretty solid. Central banks are entering the space with the central bank digital currencies, CBDCs. So digital assets are likely to be a feature of the financial system going forward, and it will need to be watched quite closely.
Wonderful. I mean, I think one sort of takeaway that I've taken from everything you've said is that what we're seeing the volatility in financial markets is it's a multitude of factors, but it's a mixture of circumstantial short-term reasons such as the war in Ukraine and the actions of central banks, but it also exposes some of the more systemic weaknesses such as those of stable coins and the volatility there that's embedded as part of the structure. Or these sort of moves in inflation that we've seen recently and the impact of the lockdown. So clearly a lot more to watch in the space in the coming weeks. But as always, thank you so much for your thoughts and insight, Brunello.
Thank you very much. Until next time.